I would like to introduce you to Steve Jennings.
All right. Thanks, Carla. Thanks for the applause. That's a lot of pressure now, so we'll see. Hopefully it goes all right. Thanks, everyone, for coming. I know it's been an interesting time in the market. We try to do this every year, and we started to put together in January. No one will come because the market only goes up. There's no volatility. There's nothing to worry about. Why come and watch economic presentation for an hour? So we said, we'll give you lunch. So thanks for coming and enjoying lunch. But since then, things have gotten a little more interesting. Obviously, we had a little bit of volatility last month. Nothing too out of the ordinary, but it's been a while. So I'm sure it did get a few nerves going. So we're just going to kind of go over where we're at in the economy, what we see kind of developing through the year, both for the economy and for markets, mostly stocks, and how that makes sense to be invested given that situation. Hopefully I can. There we go. So I mean, the economy is strong. It's doing really well. Growth is not off the charts. It's not this strong growth that we had in the 80s and the 90s. But this kind of mid 2% range, that's pretty much, given the demographics we've got, and we can get into some of that later, given the current demographics, that's probably a reasonable expectation on stocks, or on economic growth. So we used to say the natural rate of economic growth measured by domestic product is, used to be in that 4 to 5% range. Goldman Sachs says now it's about 1.6, 1.7. Last year, growth was 2.3%, so that was an above trend year. And that could be the peak of this expansion. We should get another year or two of growth, but that might have been the peak at that 1.7. And the global economy is also progressing very nicely. For a long part of this recovery, the U.S. was really the only economy growing. The rest of the world was lagging behind, still kind of in and out of recession, and not really contributing to global profits and growth. But what we see here, now please don't try to read those numbers. That's not, the colors is the trend here. So what this shows is Purchasing Managers Index by country. Purchasing Manager Index is it's a measure of economic activity. So, if manufacturing, they're busy purchasing, it goes, there's more activity. It indicates an expanding economy. So 50 is a neutral, and that's a yellow on this chart. Above 50 is green. So that's positive, that means growth, and red means contraction. So you're in a recession, there's not much manufacturing activity going on. And you can see this is over the last 2 years. I mean, it's really kind of progressed from the whole world being in yellow or kind of stuck to a solid green color. So the US on the top there, we're just been this kind of light green, it's kind of progressing along, where other countries have gone from not looking that good to more of the solid green colors. So that indicates that we've got a synchronized global recovery underway. Good economic growth, probably more demand on resources, which is something that we have to worry about down the road. Another thing that indicates growth. So there's two kind of main indicators that really have been pretty foolproof over the years that would indicate a recession is coming. And one of those is the leading economic indicators. This is an index made up of economic data that's forward-looking versus backward-looking. So it includes things like, Purchasing Managers Index would be there. Factory orders would go into that. Consumer confidence, initial unemployment claims, everything that would indicate that going forward, the economy should be in expansion mode. So also consumer confidence, which hit a new high, is in there. And from what you can see, it's still on the upswing here. I mean, we're still in the upward direction. This is something that has pretty consistently been an indicator of a recession. And it usually crosses that zero line well before a contraction starts. So we're going the other way. We're going up. Occasionally there are some false positives where it crosses that line and we don't really have a recession. But we've never been in a recession without crossing that into the negative territory. So, so that would indicate that any kind of recession or contraction in the economy is still a ways off. So there's nothing to worry about there. The other kind of reliable indicator we have is the yield curve. So what we call the yield curve, if you borrow money, typically the longer you borrow it for, the higher interest rate you're going to pay. So if you get a 15-year mortgage, that's going to be a lower interest rate than a 30-year mortgage because there's more uncertainty over that longer period of time. So what we generally look at on the yield curve is the 2-year Treasury bond versus the 10-year. So needless to say, if you were going to borrow money for 2 years, you would generally pay less interest than you would pay for 10 years, the lower annual rate, because you're paying it back faster. And what happens is you get this curve. So at 1 year, or your very low interest rate, and it kind of goes up over the time period. That's normal. So what is not normal is when you have to pay a higher interest rate for a shorter period of time. That doesn't happen very often. So what happens is the Fed starts raising rates to stop the economy from overheating, so you get to higher short-term rates. And then the market is less positive about long-term growth, so that's market forces drive those longer-term interest rates, so that 10-year Treasury bond starts to fall, and what you get is what's called an inverted yield curve. And that simply means that instead of this nice upward sloping curve, you get a downward sloping one. So the short is higher versus the long. It doesn't happen very often. It's usually a pretty good indicator of recession. From time to time we see it. People say, well, there's no recession coming. That's weird. But it's been a pretty solid indicator. This doesn't have the shaded lines on like the last chart did, unfortunately. But this is, whoops. Oh, that's my bike. Oh, there we go. So this is prior to the 2008 recession. That's prior to the 2000 recession. This is 89. So this is all, and that was obviously a mess back there, but that's when the Fed was really raising rates to combat, runaway inflation, and we were kind of in a recession that whole period. So that's a pretty good indicator. Now, the Fed has started to tighten rates, so this has started to come this direction, and there are people that are saying, okay, we might be headed to an inverted yield curve, but offsetting that, the 10-year rate has risen as well, so it hasn't gone flying across that inversion line yet. And even if it does, even if we get there, that's still a forward indicator. It's not. That means maybe in a year or so we'll have a recession. It's typically 8 to 9 months prior to the start of a recession that we start to see that inverted yield curve. So that's still pretty positive indicator. And why have stocks done so well? Well, a big part of the reason is we're seeing some of the best earnings growth we've seen in a long time. Certainly in my career. We had a nice recovery off the 08, 09 period, but we were starting from everyone lost money in 2008. Well, not everyone, but the market the S&P 500 companies as a whole did not make a profit. So we had a nice rebound from there, stalled out a little bit, and then over the last couple of years, this decline was really driven by a strong dollar and weak energy or weak oil prices. So energy companies were all losing money, and strong dollar hurts exporters. So U.S. exporters were making less money. both those dynamics changed about a year or so ago, and you had a nice acceleration. And then 2018 could be one of the best earnings growth years we've seen in a long time. And that's a lot of that's driven by tax cuts. So, brokerage firms put out earnings estimates at the beginning of the year. They're usually overly optimistic, and they come down for the remainder of the year. This year, they're actually going up. So, people came out with earnings estimates, and then they're revised upwards, saying we did not actually, they're going to make more than we thought. Usually, buy side or investment firms like mutual fund managers are more conservative in their estimates. I know Capital Group, one of the biggest managers around, managed a lot of our funds, have a earnings growth rate estimate for 2018 of over 19%, which would be pretty phenomenal. The bad news is that's a 1-year pop, and the following year they're expecting about 2.5%. So it's really driven by tax cuts. So there's obviously no reason to worry. I don't know what anyone would be concerned about. There might be a few things. Obviously we do get a lot of questions. A lot of people are worried to go into the market right now, and this is a big part of it. We have had a really good size run over the last, since 2009. We're up, it's at 317%. That's bigger than the last two bull markets. So we had the bull market late 90s, 106% from 96, and then about another double into the 2007 financial crisis. So we are up quite a bit, and our valuations are a little bit high. So stocks have an intrinsic value. It's not like Bitcoin is just like some random value that whatever anyone wants to pay you for it. It is actually backed by earnings, cash flow, profits. So this would indicate that valuations are a little bit high, but not excessively so. So the most basic metric of earnings people look at is price to earnings. So the stock price divided by what they're going to earn per share that year is the price earnings multiple, and that's kind of the most widely looked at metric. And it's a little bit high. It's right now at 18.1 times forward earnings, so 2018 earnings, and that's above the last 25-year average of 16.1. The right says standard deviation. So if you're in statistics, one standard deviation difference is not that big a deal. If you start to get to 1 or 2% times standard deviation, that's really skewed in one direction or another. So that would indicate, well, yeah, we're a little overvalued. But the thing to think about is, with 19% earnings growth, if we get a year and stocks are up 5%, those numbers will be back to average. So it's not really that high. And really, in a bull market, you have expensive stocks. Other metrics, are a little bit different. The next one down there, you hear sometimes, if you read the financial press, the CAPE ratio or Shiller PE. It's meant to be a normalized price earnings ratio, so it goes back 10 years. Which makes some sense, except that 10 years ago, and it has been a decade, we had the financial crisis. That was that line where no one earned it. Had no money. No one earned a profit. So that will fall off after this year, and that's going to make a big difference in that number. What a lot of people point to is this one on the bottom, the earnings yield spread. And without getting into the calculation details, it's really showing you what stocks yield in dividends compared to bonds. So where stocks still look inexpensive is relative to interest rates. So if interest rates are low, you might as well just buy a stock and get the dividend, because it's going to be as good as buying a bond and getting that yield, and you still have the potential for appreciation in the stock price. So that has been the argument, right? And that's the risk if rates go up, that valuation on the bottom could change, and that's been the one area where stocks do look cheap. The other thing that makes people nervous is the length of this recovery. So it's been going on for a long time. This was 34 months, actually. That's through the end of last year. So if the market's not down 20% in the next 2 days, yeah, hopefully not, we will get to 36 months, so it'll be tied for third place in the longest economic expansion. So I don't think we're going into recession by Thursday. So we'll hit the third longest. And how long can it go on? Well, the thing is, it may be the third longest in length, but in growth, it's still been relatively mild, right? We've been getting these 2%, 1% GDP numbers, and the result is cumulative growth is only 19%. So it's not, we haven't just filled up all that excess capacity and overheated in a quick pace. I mean, the one that ended, the big one through the 90s, ended with almost 39% growth. 1970s was a while ago. And the one, we're getting, there's certainly, you can't really make such a case that it's been a huge expansion from a cumulative growth standpoint. So that's why we haven't had runaway inflation yet, because it's just not that much growth overall. Oh, and I should say, feel free to ask questions anytime. As I'm sure you get tired of hearing me talk, I will. And so just jump in if you like, and we'll have time at the end for questions too, but please feel free. So valuations, do you have a question?
I was going to ask on the last slide. Mm-hmm. I'm just curious that we have 1953 at almost 29%. Well, let's stay with the annual growth. Almost 6% growth. Mm-hmm. The expansions I'm just curious as to the different markets, the different industries. The 50s.
Yeah, well.
The 60s, et cetera, et cetera.
Well, it was an interesting period. You were coming out of World War II.
Right.
And so that created a lot of growth. And then there was a lot of kind of rebuilding. There was a lot of inflation back then, not as high in the 50s, but that's a very interesting thing, and that's a good point. These are nominal GDP rates, so that's the posted number. I mean, you also had a lot of inflation in some of those cases. So, I mean, and manufacturing was a bigger part. The economy has changed quite a bit. Manufacturing tends to rebound much faster because you have unused factory space and workers you can rehire and just and you'll get a quicker recovery versus we're more a services-based economy, so that takes a longer process. So it's the natural growth rate is slowing, and there were a lot more people entering the workforce back then. So you had a lot of women go to work during the war, and then you had men come back and go to work, and you had a lot of babies being born, and so there's some demographic shifts that we'll get into.
Yeah, a lot more.
Yeah. So valuations we are a little bit overvalued, as we mentioned. So valuations are a good measure of long-term performance. They have a good correlation to what's going to happen over, say, the next 5 years. They have almost no predictive power over the short term. So correlations, +1 is perfectly correlated, -1 is perfect negative correlation. 0 means really no power to explain what will happen over the next period. So this is where we currently are at that 18 times multiple. And you'll see these are the dots are the following year returns. So in fact, I think it looks like, I didn't count, but there's a lot of really high numbers after a year where you finish a year at a high elevated valuation, 18 times earnings. There's still quite a few underneath. But as I say, in bull markets, valuations are high. People are optimistic. The economy is doing great. Earnings are growing at 19%. People are pretty optimistic. You're going to pay a lot more for a stock than you will when things are terrible. You go back to 2009, no one wanted to buy a stock. They were trading at 9 or 10 times earnings because people were pessimistic. So optimism tends to grow, and it doesn't have a big impact on short-term results. Over the longer term, earnings are a better predictor of performance. So we'll see that, at this, oops. Hey, hang on. Giving stuff away here, that's not good. So this is the 5-year number, and that's a much tighter range. So you see at this slightly overvalued level, probably mid-single digit returns is a reasonable expectation. Maybe that's 5, 6%, 7%, which is less than we've had over the last 5 years when we were coming from a price earnings multiple of 10, 11, 12 times. So we've had nice 10, 12% years over the last 5 years or so on stocks. We expect that to be a little less going forward because we've had a good run. Valuations have gotten a little expensive. What we don't know is the stream of those returns, right? It would be nice if we were going to say we're going to get 6% a year for the next 5 years. If it was 6% per year every year for the next 5 years, at maybe 0.5% per month. But we know that's not going to happen. If you could figure out the extreme of returns, that's what we're all trying to do. Probably there's going to be some volatility in there, and then there's going to be some good periods as well. Good news international. We mentioned that globally stocks the global economy is doing better. Other countries are also accelerating at good rates as well. So, and their stock markets have not had quite the rally that the U.S. has had. So you see, ACWI is the all-world index, ex the United States. It's only had less than half the recovery that the U.S. market has had. So hasn't had that recovery. Price earnings multiples right in line with long-term historical range, or at least the last 20 years. Dividend yields are right in line there. So we think international still looks good. We added to international. We've always had an international allocation. We added to that early last year. We added to it again this year, actually more to emerging markets this year. And they have started to recover. This is our earnings growth, indexed back to 100. So the U.S. is this, whatever color that is. U.S. is this line. We bottomed back there and have had kind of a pretty steady recovery. Most of the rest of the world, they bounced out of that recession, had about a year or so of recovery, and then have kind of really re-entered maybe another recession in some cases, or maybe just a stagnant period. And they've just started to recover again in the last 2 years. So they still have a lot of operating leverage that they can take advantage of. Their employment, still have higher unemployment, so more workers that can get back into the workforce. Factories running at lower capacity, so they have the ability to grow earnings beyond what the U.S. does. So in addition to having more attractive valuations, cheaper stocks, they probably have better potential for earnings growth. Now, we don't know if they're going to cut taxes, probably not, but they still have that capacity to grow for a longer period of time. So the government has 2 ways that they can adjust or manage the economy: is fiscal stimulus or fiscal policy and monetary policy. So monetary policy is what we're most used to. That's the Federal Reserve. They get together every month or so and decide what they're going to do with interest rates, and they do other things to manage the money supply. And when they want to stimulate, they will cut rates and make borrowing more attractive, money cheaper, so people hopefully take that money and invest it in projects to boost returns. The other is fiscal policy, and that's what the government does. So that's controlled by the executive branch and Congress, and they can, that generally through taxing and spending policy. So they can stimulate the economy by spending more than they're collecting. That then just puts money out into the economy. And if things are good, they want to run a budget surplus, they can spend less than they're collecting, and that will essentially slow down the economy. So I looked for, I apologize to Giants fans, but I looked for a chart that showed fiscal stimulus, but it looked very much like an economics textbook. So fiscal stimulus at full employment is a little bit like steroids. That's what you need to remember. And this is kind of the federal debt level. And economists generally measure it as a percentage of GDP. I mean, if you look at the actual number, it's staggering. But where it is relative to the economy is kind of more important. So, just kind of interestingly, this is World War II, right? Coming out of the Great Depression, weren't collecting a whole lot of taxes. Then you go straight into World War II. Spending went up, building a lot of equipment for the war. Kind of peaked up there around 120% of gross domestic product. Came all the way down. A lot of that was inflation, really. So it just raised GDP. The debt stays the same, so you kind of inflate your way out of it. They weren't not actually really paying off all that debt, although they probably were a little more restrained then. You had 1981. So you had a pretty bad economy. You kind of got through the 70s through stagflation. So you had tax cuts then, and that was fiscal stimulus. That was an effort to stimulate the economy through fiscal stimulus. Obviously, Ronald Reagan was president, but Congress was controlled by the Democrats, and it was a bipartisan bill. Overwhelmingly went through Congress with Democrat support. So that certainly added to the deficit. Obviously, there's a lot of defense spending going on then. Had a really strong economy, and then in the late 90s, we actually did run a surplus. I mean, it's hard to remember, but yeah, the debt started coming down, and that was, they stopped issuing 30-year Treasury bonds. I was at Wells Capital at the time. We thought, well, where are we going to invest money now? They can't buy a 30-year Treasury bond, that they never issue them again. But sure enough, that changed. You had the recession here in 2008. And to the extent they're natural stabilizers. So it wasn't that there was a lot of, they didn't say, hey, let's cut spending here and slow the economy down. The economy's good, taxes went up, the spending kind of stayed about the same. There you had a split Congress and presidency, so they couldn't agree to spend any money anyway. Deficit came down, you kind of went along here. So in the Great Recession, 2008, really tax revenues just fell like a rock. So that was a big part of it. And there you had tax cuts. And then they did add some infrastructure spending. So that stimulated the economy. So normally you would do this when the economy is stimulating. That's not necessarily the case. And you are actually over 100% debt to GDP. There's a lot of research that shows that would slow your overall growth rate. So that would put pressure on the ability of an economy to grow. I think I mentioned the book last time, but there's a famous book written this time is different about financial crisis. They happened to write this book right before the financial crisis, so it was a big bestseller. But so that just did a lot of research on all these and showed that really that's a risk factor as far as overall growth. Not necessarily the end of the world. Japan's at about 200% debt to GDP, but they've got other issues at the moment. So something to think about when we look at the ability of the economy to grow over the long term. So this is where we're still running pretty good deficits even without the tax cuts. I mean, we're at, this was last year, $693 billion. This is a budget, nonpartisan budget watchdog organization. So this is, the dark is where we were estimated to be without any tax cuts. The blue is the impact of the tax cuts. Green is other stuff. A lot of that's actually hurricane related. There's a lot of money going into rebuilding from natural disasters, so that kind of adds to that. Actually, that'll boost growth for a couple of years, but it does add to debt. But the blue is the big one. So see, instead of going at 600 million, you're closer to 781. That gets us to estimated over $1 trillion by 2019 and 2020. So it adds a significant amount to the debt. It's still, this is, I mean, even without that, we're at the peak of economic growth. You really should be, normally you'd be running a little more close to even. So it's, obviously it's not, we're not reliving the 90s here, but those large deficits are concerning and could be a problem down the line. And unemployment is falling. So the natural employment rate had been kind of considered around 5%. We're at 4.1. So so that's, we would definitely say that we're at full employment right here. There's questions about people doing all they can. There's been questions about the participation rate, but by most indications, the participation rate, or how many people are actually employed and looking for jobs. So this is just people that want to have a job. Consider looking for a job or employed. So if you're, there's other people in the world or the country that aren't working, that aren't counted in this, but a lot of cases they're retired or receiving Social Security, probably not going to go back to work. You get these people that get kind of kicked out of the workforce during a recession that take a while to get back in. Most of those people appear to be back in. Maybe they're not doing exactly earning as much as they were before, but they're back in. And then the other thing is, you have a drug problem that's expanding, and that's wiping a lot of people out of the workforce. So by all indications, we're pretty well approaching full employment. That's wage growth, so that's starting to move up a little bit. Really, what drives an economy, there's two things really. That's the growth of the workforce and growth in productivity. So we've had a pretty good growing workforce historically, and that's come from people entering the workforce, and it's come from immigration. So that's, so you'd asked, 1950s, well, we don't go back that far, but the workforce was growing a lot faster back then. So this is one of the demographics trends that's the reason that we have a lower potential growth rate. So we're down, expectations is the workforce is going to grow by 0.3% versus 0.6% since 2000 and much higher in the 90s and 80s. And that's because we've got a lot of baby boomers retiring. Millennials are a big group, but they're not that much bigger than the baby boomers. So for everyone retiring, if everyone entering the workforce, you have almost another person retiring. And then you got a few people in the middle called Gen X, but there's not much of us. About representative in this room as it is everywhere else. Oops. So the other thing, so really that's only 0.04% of U.S. citizens entering the workforce. The rest is coming from immigration. Obviously, you cut off immigration, that's going to impact the supply of labor. So the other thing is productivity gains. So if people can do more, that's still going to add to the economy. This is growth this is capital investment, equipment, factories, things like that. That's fallen. So companies have been reluctant to invest in plant and equipment since the recession. That's some uncertainty. The one thing that the tax change has done is there is incentives in there to invest in capital equipment. So that's something that could add to capacity. If companies really do that, add modernized facilities, that could boost productivity. That could keep us going for a little bit longer. But the workforce itself, that's kind of raising a red flag. Like we can't go on forever at 4.1% unemployment. So this is another sign that we are kind of running out of workers, is job openings. So if there's a lot of people out there that are looking for jobs, I mean, when job openings are down at these levels, you just hire kids coming out of college. It's pretty easy to find, or someone that's looking for a job that doesn't have one. When job openings start to rise, that's because those people have been already hired. So you're trying to hire people away from competitors. It takes a little while to coax them. It takes more money. You don't leave. I mean, you switch jobs mostly for money, or more. Or there's other reasons, but in general, most people switch jobs to make more money. So that's the risk. That's what drives wage inflation, right? And so that's what we've started. This would be an early indication that you are going to see wage inflation. And this is average hourly earnings. It's not a big spike, but it's more than we've seen in this recovery. And this data point up here, close to 3%, that's what started the correction in the beginning of February. That's the number we got that first February and Friday with the jobs report, and that's kind of really what started the correction. Is the market is very sensitive to any indication of inflation or rising interest rates, because that is everyone's biggest concern right now. Would mark the natural death of the expansion and the end of the business cycle. So that's something to be aware of. You start to get, when kind of late in the business cycle, you start to get a lot of focus on the jobs report, which comes out the first Friday of every month. And if you get some big numbers in there, that can really spook the market. So for that reason, I think we are probably headed towards a period of higher volatility, assuming that these trends continue, because the market is just hyper-focused on it. It's not like when things are okay, you get a good jobs report, everyone's like, yeah, okay, great, everyone's going back to work, the economy's good. It's more, you're sensitive to the end of the cycle. Barry, I think the end. Consumer prices, so this is an indication of inflation too. It's an index that measures kind of standard basket of goods that people generally buy, and if the price is going up, you're paying more inflation. This is that right there, that came out in February too, so that was the other thing that spooked the market, more indications of inflation. So is it that high? I mean, is it outrageous? No, it's not. It's still pretty low. And wage inflation is still pretty low. It's just that the market is super sensitive to this right now. So this is not indication that we got runaway inflation coming. It's just the market is really attuned to these kind of things right now, given where we're at in the cycle. And it's certainly something to keep an eye on, but realize that we're still at pretty low levels. But it's that is where the risk kind of is. And this, like the other chart, don't try to read the numbers, but red indicates inflation. Blue is below trend inflation, or below target inflation. So kind of any number below a 2 would be about neutral. Red is starting to get above 2. So we're starting to see a little bit of inflation accelerate globally. Whereas a year ago it was more kind of no inflation. A year ago we were worried about not having inflation in a lot of those countries. So I know it's hard to read, but just unless you're in Brazil or Russia, you're starting to see a little bit, some signs of inflation. And this is 10-year treasuries are kind of the benchmark for long-term interest rates. That's what most people look at interest rates. It's not manipulated by the Fed. They can't really control long-term interest rates. It's market forces. And this is kind of what the world runs on. There is some impact because they bought all those bonds trying to come out of the recession, and now they're putting them back on the market, which also is creating some concerns. But we did see, once this volatility started in February, people came out and they wanted more. They were demanding more return on those bonds. So, so this is kind of where we were February 1st, and we saw a sharp uptick in long-term interest rates. So, ultimately, that's going to be what ends the growth, ends the expansion. But that's something to keep an eye on too. So, and you also had a large issuance of Treasury bonds because we're already starting to see them require more money to fund that deficit. As payroll taxes fall, that creates a shortfall in the Treasury. Well, they'll get a little bump here coming up in the next month or so with tax collections, but that is going to have an effect. The good news is, as I say, we're still at very low rates overall. So there's a point where if you can get 5% from a bond, why buy a stock? I mean, especially if you think the next 5 years you're only going to get 5 to 6% per stocks. If you get to that 5 to 6% rate on a 10-year Treasury bond, hey, that's risk-free. That's probably not a bad investment. So that's the trade-off. That's why when bonds go up or stocks sell off, because the worry is everyone's going to switch their money and buy bonds. Well, we're still at pretty low levels. So there's really, I got to figure out these buttons at some point, maybe by the end of the presentation. So what this shows is correlations from interest rates to stocks. So when we're at these very low levels, below about 5%, an increase in interest rates still has been a positive for stocks because it means that growth is improving, growth is accelerating. So interest rates are going up for the right reasons. So that's a reason to believe that stocks might do better. So when you get these very low levels, rising interest rates can actually be a good thing. Historically, it's been around 5%, and then you start to get that trade-off where there's negative correlation, where when bonds do well, stocks do poorly. But it may not be 5% this time because I think we are in a period of generally lower interest rates, certainly from what most of us in this room are used to. So it might not be 5% anymore, but we're still at pretty low interest rates. So I wouldn't be overly concerned about interest rates as a whole. There's a saying on Wall Street, don't fight the Fed. And that kind of comes about from the concern over interest rates. Fed starts raising interest rates, the market sells off, everyone panics. We've got inflation, everything else, rising rates. It's going to be bad for stocks. Well, that's not necessarily true, actually. It does cause volatility. When the Fed raises rates, it causes volatility, especially when you start the first interest rate hike of a tightening cycle. That really causes volatility. But the markets and the economy don't usually peak until after the tightening cycle is over. So cyclical stocks usually actually do quite well during a Fed tightening cycle. So, historically what you've actually wanted to own is things like technology, industrials, economically sensitive stocks. During a tightening cycle, you want to avoid interest rate sensitive stocks like utilities and telecom. So really, this just kind of shows that trend has really held. This goes back about 30 years or so. So when the blue line is federal fund rates. So this was a tightening cycle in coming out of they cut after the dot-com crash, right? And then they started tightening rates. They stopped that tightening cycle at 5.25% on Fed funds rate on August 2006. The market didn't peak to almost a year later, 2007. And the recession was after that. The one before that, going dot-com bubble, they stopped tightening rates in June of 2000. That was the last hike when they got to 6.5. You still had about 3 months before the market peaked. And it's the same thing. 95, we didn't really, that managed pretty well. I mean, you didn't really have a big peak there. And you certainly didn't have a sell-off. Like these last two sell-offs have been very dramatic. I mean, you had market crash basically twice in the last 20 years. You had 2000, which is really driven by technology stocks, right? If you didn't own technology stocks, you wouldn't have noticed. And then the last one was more of a broad sell-off. These other ones are really more typical. A typical bear market in stocks is 20 to 30% down, which hurts, but it's certainly nothing like we've seen. Then you had March of '89, peaked at 9.5%. And then you still had a couple months before they downturned. So, and then you get a sell-off early. September '87, when they started the tightening cycle, you had a big sell-off, but it actually recovered all that before the tightening cycle was over. And we had a little volatility when the tightening cycle started back here around 2015. I mean, you had some volatility there. But the Fed thinks that, they're just getting started. There was a lot of expectations for 3 more rate hikes this year. Some people now are saying 4 because we're starting to see a little bit more inflation. As long as the Fed's still tightening rates, we're probably in pretty good shape because it still means the economy is growing. So you may still see some volatility when they hike, but overall that's a good thing, and really especially in the more cyclical areas. The other thing that should keep a lid on interest rates is, although rates seem pretty low at 3% or just under on the 10-year, especially for most of us that remember much higher rates, if you're in Germany, they look pretty good. So, so if the investors are global these days. So if you want to buy sovereign debt of an investment-grade country, where else are you going to go? I mean, we have the most attractive returns. You may be worried about the dollar being weak, but at 3%, we're looking pretty good compared to, the UK's got its own set of problems, so rates are a little bit higher. I mean, Germany, at least they're positive now. You don't have to pay them to hold your money, but they're still only around 0.5%. So as long as that dynamic stays in place, we're not likely to see a real spike in interest rates. Yeah, another question is, well, we're probably we're late in the cycle. Everyone agrees we're late in the cycle. So, do you want to pull all your money out and then just kind of sit around and wait for stocks to go down? Actually some of the best returns, the biggest returns come towards the end. This really just shows the last 2 years of an expansion. And typically that second to last year is the best in the blue line. So this goes back about 80 years. And you'll see kind of 14% the last time, 12%, 21%, 17%. So 2 years before the end of the expansion, a lot of people believe that this may be about the second to last year. Maybe you could argue the worst case, we only have a year. So even the last year, you're still generally generating positive returns. So the last 2 years, you're getting 23%. Going into 01, that was a little bit different because the dot-com stocks had collapsed at that point, so that put some pressure on the market. But generally, you're getting really high returns there by holding stocks the last 2 years. So even if you avoid a 20 to 30% downtrend, that's why we say don't time the market. You want to be there for the last couple of years because you're still going to get, that's some of the most important sources of return. It does make sense to manage your risk. I'm not saying go all in stocks. Buy some things that are not correlated to stocks, prepare for that downturn, pay attention to the risk, but don't just bail out because you're thinking, well, if I sit out the last couple of years, I'll be fine. You're probably you may miss the downturn, but you're gonna miss the upturns too. So you're probably not really gonna do yourself many favors. Other risks. So that's the natural progression of the business cycle. That's what everyone's focused on. There are other ways that expansions end. and that's kind of external risks, a war. I think the one thing that everyone's focused on now is probably free trade. So if you get into a trade war, something like that, that could disrupt the economy, and that could cut us short outside of the natural business cycle, which looks like we still have a year or two left on the expansion at least. So that would be cause for alarm. And then other things, I mean, really, if we saw them coming, we wouldn't. Generally, you don't see the things that you don't see coming, right? If you see something coming, you can adjust. The one thing, I do think trade is actually the one thing that most people are focused on. But yeah, there's other things out there. So that's not the only way for a business cycle to end, but that's that's kind of what we're looking for. That looks like it'll be the cause this time, but we're still several years out. So in conclusion, economy looks in good shape. U.S. growth may have peaked, but still got a couple years ahead of us. International looks even a little bit better, more opportunity there, kind of a longer expansion ahead, better valuations. The dollar has been the risk there. So we had 4 or 5 years of underperformance by international markets. It's because we had a strong dollar. But right now the dollar got really strong. It's kind of unsustainably so. So it's been weaker the last year. That will probably continue. But even if it's not weaker, it's probably not going to move dramatically. Later stages, probably a pretty good time to stay invested. Just pay close attention to interest rates and inflation. That's really what's causing the volatility and what will probably continue to do so. As I say, at low rates, that's not necessarily. Rising rates can be a good thing for stocks. The exception is when you get a spike in interest rates. So we had a spike in the 10-year Treasury, and that concerns stocks even more because it moved up so rapidly. But generally, a even move up is okay. Growing debt, that's something that's concern for the longer term, that it would cause. At some point, that has to be managed. You can't say 200. You can't be Japan forever. At some point, say a country like Japan really has a demographic problem because they have 200% debt to GDP. They have been a nation of savers, so everyone in the country owns national debt. But the problem is they're retiring. They don't have. It's a very old population. So we'll see what happens there. Hopefully, it's a warning sign for the U.S. And without an external shock, it's not likely to have a recession or a bear market in the next year to two. So that's it. Anyone want predictions on the baseball season? Or any questions? Or Larry?
So my understanding is a great deal of money is from foreign countries in that market. Is there any
Yes.
indication that concerning the administration's position and the conflicts that they're pulling out some of the money? It seems like you indicated because our market's so strong now, but is there a trend there?
Yeah, I mean, the U.S. is, so the question was foreign investment in U.S. stocks. The U.S. has always attracted foreign investment. Right now, we're about half the overall market capitalization. I think there will always be foreign investment as other countries' markets grow. I mean, that may and look more attractive. Some of that capital may move around, but I think it's always going to be a pretty good. I don't think that as far as countries being concerned about policies and things like that, I think if they were going to pull money out of an area, it would be treasuries, which would probably be a bigger problem. China is a huge holder of U.S. Treasury debt, so that would be a concern. But again, it makes sense for our trade partners to have stakes in equities and bonds in the U.S. So I don't think I see it as being a big concern for the market. But as foreign opportunities could look more attractive, you might see some capital move around.
Isn't it true, Steve, that there has been a lot of sell-off in treasuries by foreign powers?
Yeah, I mean, Yeah, well, there's a lot of supply out there too, as part of the issue. I mean, China is the big holder, and they make grumblings about really reducing their holdings, but it hasn't been significant. If they really wanted to cut their treasury holdings, I mean, it would make a dramatic impact in interest rates. So they do own a lot, but it's also a lot owned by insurance companies, institutional money managers, and foreigners too. I mean, other foreign private institutions in addition to foreign governments. China just owns a lot because we're running such a trade deficit that they need to put their money somewhere. So, they may use that as a tool or as a weapon, as a threat, and it could potentially be, it would certainly move the markets, but I think it would be hard for them to really make a massive sell-off, and it would hurt them. It would hurt their holdings too, right? If they sold half of it, the other half would fall in value.
What's their benefit of doing that?
Yeah, it would just be.
I'm not sure what their benefit would be.
Yeah, it would be, be more in retaliation
Right.
if we put up trade barriers or tariffs. They can say, well, we're not going to hold your. So that is the risk. That's that external risk, right? We start getting in fights with our trade partners, and they want to put tariffs up, and they want to sell treasuries. That is I think that's the one external risk that.
One other question I had, and that was probably an external risk. Would you speak to, as far as you're concerned, on the near term, the weakening of the petrodollar with all these external trade agreements?
Of the dollar, did you say?
No, the weakening of the petrodollar
Oh,
through a lot of the other big countries are making trade agreements among themselves,
yeah.
circumventing the petrodollar.
Well, yeah. I mean, anything that gets in the way of free trade is going to affect, currency movements. And the ideal for the economy, ideally, you just have free trade with everyone, and everyone played fair. I mean, you do have to watch out for, companies subsidizing it. But yeah, I don't have a whole lot to say on that, but just, I think trade is going to be the probably biggest political issue going forward, outside of all this other stuff going on. But as far as political issues that affect the economy, I think trade is going to be the biggest one to watch. I don't necessarily have a comment on individual currencies, but yeah. Keith and Holly both had a question at the same time. We better let Holly go first.
All right. So given all your research, have you developed a philosophy for this year for handling portfolios?
Yeah, I think our philosophies were still positive on U.S. stocks, but more so on international stocks. So we did move middle to international. We think it's a little too early to dramatically pull risk off the table. But we've started to add some, lower volatility investments just in case. But our belief is that it's still, reevaluate this on an ongoing basis. But so in February, I'm here saying it looks good through to December, which is our belief right now. That's kind of what we look for. So we think it's too early to really start to pull significant risk off the table. If there's lower volatility alternatives, things that are not correlated with stocks necessarily, we may add to those to reduce risk a little bit, but it's not something that we're super concerned about yet. Our belief is that we will continue to see another good year. And if it's not as good a year as last year, but still up, that could be a positive too, because the valuations start to look better. Keith look better. I'm sure you're going to ask the same thing. Been married a few years.
Two questions. One is, I understand that a lot of people the last couple of years with the stock market not being volatile jumped into margins and borrowing large amounts to buy stocks.
to the point that it's about the highest level of borrowing that we've seen historically in that area. What's the impact of that? And is there a concern there? The other is, I understand that a lot of the companies that are benefiting from the tax cut, instead of investing in more equipment or expanding, are instead buying back their stocks, which is inflating the value of the stocks, possibly artificially. So what's the impact of those two actions that are going on?
Yeah, so first on margin debt, yes, it's very high. There is a lot of there has been a lot of complacency in the market. So margin debt was high, which is a risk to stocks because people have to cover their shorts or want to reduce their leverage. I mean, that was a big, in the 1929 crash, I mean, margin was off the charts. So people borrowing money. So that's a risk to stocks. I mean, kind of also along those lines, there was a short volatility trade, and those things all blew up. So everyone was betting on low volatility, and it went high, and a bunch of products that help people do that actually, what we call blow up. They were down 95% and shut down. So that is, a little volatility is actually good for the market if it can keep people honest. So ideally, you would get, little shakeups like we had, a 10% down, which is not, in the grand scheme of things, that's not huge volatility. That's normal. I mean, 10% correction, that should happen every so often. And it was unusual that we went for such a long period without one. So I think it's a positive if we have some volatility enough to keep people a little more honest. That means that there's more opportunity to rally from there. So while it is a risk, volatility without a catastrophe is probably a good thing. So I think that's where I think this kind of thing is a positive. Actually, for a lot of us, it felt good to have that sell-off because you had started the year out of the gate just at an incredible pace. So a lot of people felt it was a technical correction as much as anything driven by fundamentals like rising interest rates. And in a lot of ways, it was healthy for the market in that respect. As far as buying back shares, so since this recovery has started, that is pretty much all companies have done with their cash flows, is repurchase shares. They have been very reluctant to invest in plant and equipment, which is not a good thing for the overall economy because it inflates it because there's less shares outstanding, so your earnings per share are higher. You might have the same or actually slightly lower income because maybe you have more debt and you're paying more interest, but you have less shares outstanding, so your earnings per share are higher, and it makes it look like you're growing when maybe you're not really growing to that extent, and it doesn't really benefit the structure of the overall economy, ability to grow. It has been very frustrating that companies have not invested in plant and equipment. So there's a lot of good things about there's a lot of bad things about the tax cut, I think, and a lot of good things. I think incentives to invest in plant and equipment are a positive. We'll have to see if companies actually do it. But if you can take money back from that's sitting overseas and hopefully be incented to invest that in plant and equipment, that could be a really good thing if companies actually do it. So, jury is out. We can evaluate this time next year. Paul.
To piggyback on the last comments, is there any hard evidence that bigger companies besides just buying back shares are really trying to invest in education and retraining of people that are in that 4% unemployment group? And if not, doesn't that present a pretty serious issue for unemployment in the future? They can't fill tech jobs because people just aren't being retrained.
So trying to repeat the questions here to make sure everyone hears them. So are companies reinvesting or was it investing in retraining employees to fill?
Or just not retraining employees.
Using a tax cut.
People who aren't otherwise coming out of school or whatever.
Yeah, so invest that money in training, tax cuts. I don't think companies are going to do that. I think that's I mean, companies generally have some kind of training program. It seems like there's a bigger disconnect than that.
Do you see the government doing
I think my personal feeling is it probably is the role of the government. Do I see them doing that? Yeah, I mean, I think there's probably a big discussion about the education system and, where it stops. And, it kind of stops at high school, right? But you need more of an education. You need more than a high school education today. So should we have vocational schools? Should we have more utilitarian type college programs where you can at least go to school for another 4 years without going into debt for the rest of your life? I think there's a lot of room for discussion there. I don't see the private sector investing in a lot of education because there's too much. I mean, you can get someone close. If someone's close, you can bring them the rest of the way. But if someone's needs another 4 to 6 years of schooling, I don't think they're willing to invest in that. Okay. Well, I think that's it. Well, we'll be around for a little while. So thanks, everyone. Do you have any questions?